Hey guys, Bill Ladd, Duckett Ladd Dental CPAs and Advisors. And today we are going to talk a little bit about unrelated business income tax for you investors out there who have maybe some self-directed IRAs. This is something that may be of note to you. So we're going to go ahead and dive in, and I'm going to share my screen here. And we're going to start talking about unrelated business income tax. And again, guys, before we start any presentation, I always like to say that this is educational. Yeah, it's for educational purposes only. For most of you, I don't know your tax situation. So anything we talk about here, any strategies or tax implications, you really need to sit down and talk to your advisor just to make sure that it does apply to you, or it's something you should be concerned about. So getting out of the way, we're going to hit on, again, unrelated business income tax. And I always like to do tax trainings and tax seminars with kind of answering three questions: why we have it, why should I care, and how do I prepare for it? So let's jump in. Why we have it, and this is really a logical thing when you think about it. In the past, let's say you had a nonprofit, and before these rules were enacted, let's say that you went out and you had a nonprofit and you operated a gas station, just as an example, and you're doing that gas station work and making money, and you're not having to pay tax on that. You're a nonprofit, right? So that created an unfair advantage. So what they really wanted to do with these provisions is curb for-profit activities in nonprofit entities. That was kind of the emphasis when these things kicked off. Now, they also kind of dovetailed into retirement accounts because, as you know, a lot of retirement accounts, they're designed to discourage active trade or business and tax-free deferred retirement accounts. They want you to keep that money in retirement. They want you to put it in stuff that, for the most part, is pretty straightforward and designed to kind of build, your retirement account balance. So again, they're trying to discourage you from using that retirement account to do active trade or businesses and not have to pay tax on that. So why should I care? Well, it is easy to miss and can definitely be costly. If you're not careful, this is something that you could find out after the fact, and it could be a big problem. Not to mention, many of the clients I work with, they're more involved in alternative investments, real estate, for instance. And a lot of real estate deals, they're leveraged, and that can cause unrelated debt financing income, which is another kind of unrelated business income tax. Think of unrelated business income tax as kind of those for-profit entities, like say that gas station and a for-profit, that has no bearing on a charitable intent or purpose. Think of unrelated debt financing income as, the ability for you to invest in real estate or something. And if it has debt leveraged against it, that could potentially kick in a portion of that income as unrelated debt financed income. And again, this is primarily going to apply to self-directed IRAs in this discussion. So let's do a little bit deeper dive as we continue to figure out, why should I care about this? So let's go through an example here. Self-directed IRA places money in a syndication. Okay, very common situation. Syndication that's purchasing an apartment complex. That syndication uses capital, money they've raised, and debt to acquire the apartment complex. Again, a very common situation. The problem is when you have money coming from a self-directed IRA, a portion of those earnings, if there is net earnings, will be taxed at trust rates. And for many of you guys out there who actually have trust or irrevocable trust and kind of know how that works, the problem is that trust rates are extremely truncated. They're much smaller. So you hit those higher thresholds quicker. Take a look at these charts here. In 2021, the tax brackets and rates for married individuals filing joint, 10%, 12%, 22%. You can see To get to 37%, you have to have over 628,300, again, as a married filing joint. Now, conversely, look over at the estate and trust rate. All you have to do is get over $13,050, and you're sitting at the trust rates. This is legislation that was presented years ago to really curb people from using trust to kind of shift income. So they really truncated those rates down. So you can see it doesn't take much, and you're paying a max tax rate on that. And that could be a problem, something to be aware of. So how do we prepare for it? Well, communication with your investing partners and CPA is key. I mean, obviously knowledge is first and foremost, understand it, but UBIT on LLCs owned by IRAs are particularly easy to miss. It's very simple if you had a self-directed IRA to go out and get a checkbook LLC where you're starting to put money to work. But if the potential sponsor doesn't know that you're an IRA, then they may not report to give you the adequate disclosures that you need to file unrelated business income tax or unrelated debt financed income. And it is your responsibility as the IRA holder to report that. So, it's important that you communicate with your investing partners up front. And then you just need to understand the potential impact. And here's a simple way to look at it. Let's take a very simple situation. Generally, the portion of unrelated debt finance income will be the percentage of debt financing a property. Super simple example. You have a $100,000 property with $80,000 of debt. That's an 80% leverage rate. So 80% of whatever income flows down to you on a K1 could potentially be subject to unrelated debt financed income if it's done through a tax deferred account, like a self-directed IRA. Now, 401ks are different. We'll get into that in a second. So what do you need to do as you continue to prepare for it? Well, if we invest with a IRA, self-directed IRA, we need to keep an eye out in the K1s and make sure it has UBIT or unrelated debt finance income disclosures. If not, then you want to get a hold of that deal sponsor and ask them about it. Ask them if there is any, and ask them if they can revise the K1s to reflect any. Now, if you do get one and you do see it has unrelated debt financed income, you need to file a 990T, and you need to go ahead and pay your tax, if any. You may have different investments that kind of net down and may not have taxable income net on your 990T. So, you may not have any, but the key thing is you do have to pay that tax out of an IRA. So again, you just want to be careful when you're investing your IRA money into a syndication or something that could potentially have debt financed income. You just need to be aware of that. So here's a few tips. Obviously, one of the most important tips you can do as you're getting more into alternative investing and you're trusting your money with other people is just make sure you're dealing with experienced investment partners and study up on those deals. Make sure you understand what you're getting into. Hopefully you now have context that if you're putting your money into something that has debt financing, then there could be an issue and you may have some tax, and you have to factor that in when you're looking at your return. You also need to give your W-9 to your investing partners. Again, a lot of times you'll have a checkbook LLC and it will have some name that doesn't indicate it's an IRA. So the accountant who gets that return or prepares that return for that deal, they may look at that LLC and say, well, that's probably a partnership, and put in partnership when in reality, it's a retirement account that would have triggered them to analyze for unrelated debt finance income and put appropriate disclosures. So make sure your investing partners are aware that you are self-directing through an IRA. And another thing you can potentially do is if you do have K1 income flow through, and let's say it's a syndication deal that has losses, and it shows a net loss. What you might want to consider doing is filing a 990T, even if that's loss, so you can start generating net operating losses to offset future gains, because at some point you will likely have a taxable gain event off of that. Maybe when that sells and if it sells and it's appreciated, there could potentially be a gain that you'll want to offset. So start getting an NOL built up so you can offset when the time comes. And I've actually seen people do this. If there was a 990 T that was not filed, but there were losses, and then all of a sudden you have a big gain year and you have tax, I've seen people go back and file previous 990 Ts to generate those losses to offset that gain. Now, certainly want to get with your CPA, make sure that's not an issue. And if it's not, then go ahead and you might want to get those and trigger them so that you can try to offset some of that gain. And an interesting thing is that I've been talking about self-directed IRAs. I really haven't spent much time talking about self-directed 401ks. And an interesting component of unrelated debt finance income, not unrelated business income tax, but the component that's unrelated debt finance income, it does not apply to 401ks. So in this situation, if you have a self-directed 401k that's invested in these with the leverage, then that is not going to subject you to unrelated debt financed income. So that's something you want to keep an eye on. You want to be aware of. If you have that self-directed 401k, you have a little bit more latitude to put money into these kind of deals without triggering that. So again, primarily the discussion today is going to be self-directed retirement accounts, IRAs. Okay, so some simple questions as you're dealing with these situations. And again, you want to get the right partners. As you're putting money into alternative investments, you want to make sure you have a great investment partner. So here's some simple questions you can ask. How many deals have you fully completed? We want to make sure that this is and by fully completed, I mean brought to a disposition and paid out, pref returns, everything else that you're expecting. How many have you done? You want to make sure you're dealing with somebody who has some experience and has a track record of delivering. How many IRAs are invested in your deals? Are there potential downfalls? Do you communicate with them that this is not necessarily an IRA friendly, in the fact that it could have some unrelated debt finance income disclosures? Good syndicators and good deal sponsors will know this. They'll know that this is not a situation, and then it's just a different conversation. You have to kind of look at your return and make sure it still makes sense. And then finally, does your CPA know how to, and do they properly report any unrelated business income tax? Again, primarily we're talking about that unrelated debt finance income. I need to know I'm going to get a K1 that's going to have the proper disclosures and that are going to help. So guys, this is just a really brief tutorial on unrelated business income tax, how it affects you, how it could affect you as you're getting into alternative investing. And again, we're going to really we have focused in on self-directed IRAs that are investing in real estate that is leveraged. If you're doing other kind of business activities, out there, you just want to be very careful to make sure that it is not something that would be considered an unrelated business income tax, something that is not in conjunction with your retirement goals. If it's an active trade or business in your retirement, there could be a problem there with unrelated business income tax. There are all kinds of rules with self-directed. As far as self-dealing, you have to be super careful about, and that's outside the scope of this. That's why you want to get a really good dance partner with your self-directed IRA to make sure they understand the rules, that they're able to communicate the rules to you. And if you have any doubt about whether a self-directed deal is a good one or an allowed one, you need to make sure you run it by your CPA, run it by your self-directed IRA custodian, and then also potentially a tax attorney, because if you screw up, it can be a big, big deal. Guys, hopefully this was helpful, and we'll continue to do more of these little tax topics that will try to help you guys out as you're looking at the tax side of things, whether it's in your practice or whether it's as far as your alternative investment. But my name is Bill Ladd. I am a partner at Duckett Ladd Dental CPAs and Advisors. And hopefully this helps. And if you ever need anything from us, feel free to reach out. with that, guys, we will say thank you, and we will end this topic.